Welcome to the September 9th, 2024 Advanced Report for McGowan Group clients and networthradio.com listeners. Well, September began with a little 600 and something point sell-off in the Dow, and correspondingly the NASDAQ was down 3% on the first day and S&P down 2%. September is historically the worst performing equity month of the year, averaging a decline of about 1.25% for the month all the way back to 1928. So traders are a little superstitious. Most people think October's the worst month because of the crash of '87 and the crash of '29. But it's actually September. But 1.2% wouldn't be too much considering what's happened over the past year. Wow, the Dow up nearly 20% even after Monday's swoon, the NASDAQ up 23%, and the S&P 500 over the past year, not year to date, up 24%. Wow, okay, this was the August meltdown, and everything recovered after that, and it ended up being a pretty good month by the time it was all over. Part of this is GDP, real economic growth, running at 2% this quarter according to the Atlanta Fed, 3% last quarter. What's the 20-year average for economic growth? It's actually 2.1% with two major recessions, 2008 and of course the 2020 meltdown. All right. What triggered it? Well, they were trying to explain it in the financial headlines, and they said, oh, manufacturing is in contraction. Above 50 is expansion. Ooh, you can see 2021. That was the recovery from the pandemic. But here, it's running below 50, meaning a contraction in manufacturing compared to the year prior. This boom was overfunded government spending to a large degree, infrastructure, the CHIPS Act, and things like that. Well, that may continue for some time, but that was the number that they used to explain that first sell-off. All right, GDP. Here's the story. We go back to the pandemic. GDP contracted briefly during the shutdown at an annualized rate of minus 28. Then it recovered with an annualized pace the next quarter of 34%. That was pretty volatile. But most of the time, as I said, over the last 20 years, GDP has run at about 2.1%. That's the normal trend line. Man, despite all the headlines, every time the market goes down, you see lots of headlines, looming recession. What you want to watch is jobs. You see negative jobs or failures within companies, then you have a sign of a recession. That's why you subscribe to YouTube McGowan Group. I'm Spencer McGowan, your financial weatherman and president, McGowan Group Wealth Management, serving affluent families right here from the Crescent in Dallas. You can actually click through to networthradio.com. Contact us there to set your time for a brainstorming session and an updated plan. What's this? Oil this week just smashed down below $70 a barrel. You would think there's a whole bunch of oil. Now, the main inventories in the U.S. are Cushing in Oklahoma. It's where all the pipes come together. And I wanted to see, wow, what's the state of inventories? Is it like we have so much oil that we can't get rid of it all? Well, the decline, part of that was a trading phenomena, but the inventories moved the other direction. You could see the last few months going down to below 28 million barrels. What is that? Well, that's pretty low compared to the 5-year average. Wow, that's at the lower end of the range. So inventory is getting used up. ExxonMobil actually said they're joining OPEC and saying there is no way that we can meet demand over the longer term with current money being spent to increase production. In other words, we're underinvested in energy infrastructure, and that's a key asset class here at McGowan Group Wealth Management because you get a nice dividend and you do have potential shortages setting up in the future, which could create a windfall over and above at 7 times cash flow. It's an estimate of maybe 15% forward yield to owner. And that's a pretty good category that served us well. And this says, in fact, ExxonMobil may be correct. You can see what happened, of course, in the pandemic. And this was the shale revolution. An important lesson. Overinvestment in 2014 led to huge inventory growth. The U.S. shocked the world. And the pipeline build out occurred during this. About 2018, you worked off that surplus. And what happened after that? Well, you had the pandemic, but now this is a low end for the inventories, and that bodes well for the value of infrastructure. What's this? Munis over the last year. Wow. So we're looking at a 17% return in one of the municipal funds that we watch. It has a 7% yield right now. That's pretty strong. And so not a recommendation for your portfolio until you come down and actually get a plan. But over 7 tax-free, that's pretty good. The Fed's about to cut rates. And this is still priced 9 or 10% below the value of the bonds. Wow. So it had an anticipation. You can see in 2022 and 23, the value at risk of loss during the Fed tightening, which really concluded in October with a rate spike in 2023. And you can see, wow, it got cheap. So municipals, global high yield, still a good opportunity, especially as the Fed cuts rates. Thank you for tuning in. Be sure to subscribe and go to networthradio.com. Contact us there. Thank you for tuning in today to Net Worth Media. We also have Apple Podcast. Simply type in Net Worth Radio and boom, it'll hit your phone right then. If you also go to networthradio.com on a browser, you're going to be able to meet the team. You can see our performance track record, the model portfolios that go with today's broadcast. Also at networthradio.com, the Longer Play podcast is available there as well. We're grateful that you've tuned in. Remember, when we talk about a security, it doesn't make it a recommendation for your portfolio until we actually complete a written plan for you by Zoom or in office or simply a conference call. So you reach us at networthradio.com if you want to get that arranged. Market fluctuations and how to handle them. We build high cash flow portfolios, and past performance doesn't guarantee future results, so you do have to be ready for challenging markets. We can build more cash flow during challenging markets than we can when everybody's happy and everything's up, which is when we tend to raise tactical safety. Those allocation strategies are here at networthradio.com. Thank you for tuning in.